Morgan Stanley commodities analyst Tom Price says the price of gold could go as low as $800 an ounce in a worst-case scenario, and he joins us now from London. All right, Tom, I didn't want to steal your thunder, but why do you think that the price of gold might go to 800?
Well, I mean, it's a tough time for commodity analysts like me at the moment. The numbers are moving so fast, so we're really struggling to find a benchmark that we can believe in. And the number I came up with, which was actually 870, is based on the marginal cost of production for that particular metal. That would upset a lot of people, me talking about fundamentals in gold, but because a lot of people don't believe fundamentals apply. But in a sell-off scenario like this, it's probably worth thinking about.
Tom, is this really all in anticipation of higher rates? I mean, we've seen so many different asset classes move in anticipation of the U.S. Fed raising rates. You know, Treasuries priced this in many months ago. Why is the gold market moving now?
Oh, well, the gold price is held up on an extraordinarily wide range of drivers. Everyone's been thinking about the impact of the Greek debt risk, also some conflicts in Eastern Europe. So they've been looking for reasons to stay in the space. And I think one of the benefits that gold's had in recent months is a very large sell-off across other commodities. In base metals and oil, for example, they've come off about 20–25% since their local high back in May. And I think some investors in commodities have retreated into gold. But now that we're getting closer to a point of an interest rate hike in the US, I don't think gold can hold up for much longer. So I think there's probably going to be a departure from the gold space as well.
Tom, take us through the commodity complex and begin with oil and tell us your price perspective.
Okay, well, the energy space, the oil prices, WTI and Brent, are now sitting in a range of 48–55. We're thinking of prices of about $50 to $60 a barrel over the next 6 to 12 months. The rest of the commodity space, we're probably about 10 to 15% above where spot prices are for copper, aluminium, nickel and zinc. So they've really been hammered at the moment. And of course, gold's come off about $50 to $100 an ounce. The selling pressure is really China-centric. The issue, or the catalyst that we've seen just in the last few weeks, has been the equity market collapse. And there's actually a crossover between equity markets and commodity trades in China. They have trouble short-selling equities, and so being commodity-rich, we're seeing some evidence that they're selling commodities just to cover losses in equities, and that's dumping product in the market, and I think that's one of the short-term pressures on the space at the moment.
Tom, where do you think the floor is for iron ore?
Iron ore, well, it's currently trading about $50 a tonne, landed somewhere in North China. Right now, the trade should remain stable at about that level, $50. Usually stays very stable between May and August every year, but then it should pull back after August. Around September, October, you see steel producers cut production, and iron ore and steel prices will come under pressure there. So there could be a risk of a correction event around September, October. It happens every year, so you could probably see a short-term price of $30 to $40 in that period. But $50, expect a price of that level over the next couple of months.
Tom, what's the best trade right now?
Well, it's a defensive one, and there aren't too many places to hide in commodity world. Probably the commodities that would be most insensitive to the current selling pressure would be the coal space. So thermal coal and metallurgical coal used in power generation and steel production have been hammered so hard in the last 2 or 3 years, their downside's quite limited. So if you can find an equity to invest in there or just pick up coal itself, I'd probably recommend thermal and met coal.
All right. I want to thank you very much for joining us. Our thanks to Tom Price. He is commodities analyst at Morgan Stanley, joining us from London.